I'm not saying that gold's going to go to 3,600. I am saying it wouldn't shock me if it did. The downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends. Leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. The trigger was the dollar shortage. So it was sell gold, get dollars to buy oil because you need the oil. Central bank buying, flat mining output, inflation concerns, uncertainty, et cetera. Gold should go up. Late this year, early next year, $10,000 an ounce is still intact. Well, why are they buying this gold? No, yes, gold did surpass treasuries as the percentage of total reserve assets. The Russian reserve position was approximately $600 billion. Of that, $150 billion, or 25%, was in gold, physical gold bullion in Moscow. We're not talking about tokens or futures or anything else. They had the gold in Russia. Euroclear and Citadel, DTC. The Russians had 200 billion out of their 300 billion in custody at Euroclear in Belgium.
I want to kick the conversation off with gold and silver markets as we see gold around 4,000, silver around 60, a fairly dramatic correction so far after both metals hit all-time highs in January, although they seem to be bouncing back somewhat today as we speak. I believe silver up close to 4%. Well, what are your thoughts on this recent price action? Is this a buy the dip opportunity or a time to exercise caution in your view?
I'll give you a longer explanation, Jesse, but the short answer is it is a really good entry point, buy the dip opportunity if you want to put it that way. Of course, I watch it closely, and you're right. End of January hit an all-time high. It was 53, 55. That was a closing price. You can get different numbers intraday depending on what ticker you look at, but call it 5,400 for a round number. But I think the ticker I use said 53, 55. It's down around 4,000 an ounce. It dipped a little bit below that. It was a three handle there for a while. It was like 3,900, 3,950, something like that. But you're right. It seems to have settled in around 4,000. So we all see the price action. The question is, what is this? Did we hit a peak and was that a bubble or a hyper spike? And now it's going to keep going down and, get out while the getting's good, et cetera.
Gold has fallen sharply, and many investors believe the rally is over. But what if this pullback is actually setting up the next major move? According to Jim Rickards, the forces driving gold higher haven't disappeared. In fact, central banks are still buying, geopolitical risks remain elevated, and the recent sell-off may have been caused by something most investors completely missed. In today's video, we'll break down why Jim believes this correction could be one of the best buying opportunities yet, what really pushed gold lower, and why he still sees the potential for much higher prices ahead. So let's begin by looking at what really caused gold's recent decline.
Or is this just how it goes? Is this a normal, not unexpected commodities price drawdown and a good setup for the next leg up to a much higher level? I am sure that it's the latter, that this is a drawdown, and it's where my target, my intermediate target, meaning late this year, early next year, $10,000 an ounce is still intact. Now, that's easy to say, but let me kind of look behind the curtain a little bit and kind of analyze that. The fundamentals have not changed. When I say fundamentals, uncertainty in the Persian Gulf, uncertainty in the war in Ukraine, central banks are still net buyers. China's buying hand over fist. Mining output is flat. I'm not saying peak gold in terms of mining, but when you have flattish supply and rising demand, that's a recipe for higher prices. And pardon me, we can all see what's going on with inflation. So none of those fundamentals have changed. So what did happen? Well, a couple of things. Number one, when the war in Iran broke out at the end of February, but you can kind of see it coming, they shut the Straits of Hormuz, and it was a time when it was a double blockade. Iran was blockading the Straits, and the U.S. Navy was sitting out in the Arabian Sea. So Iran didn't let anybody through unless you were a friend of Iran or China and you paid a toll. But if you met those criteria and you got through, the U.S. Navy was waiting outside to board your vessel, blow you up, and turn you around. So how many people in the world were friends of both? The answer is nobody. You were either pro-Iranian, then the Navy stopped you, or you were anti-Iranian, and the Iranians stopped you. So it really was shut off. And I don't have to recite all the statistics. We all, 20% of the world's oil, 20% of the world's liquid natural gas. The larger percentage of the sulfur, people are like, what the heck is sulfur? I mean, they know what it is, but like, why is that so important? It's a precursor chemical in just about every important chemical process you can think of. And then also a major source of helium. Like, yeah, you blow up party balloons. No, yes, but you need helium to make semiconductors. So, and then aluminum, and then nitrogen, nitrates to make fertilizer to feed the world. The implications of this are mind-boggling. Again, people have been through that for the last couple of months. Some vessels are getting through right now, but not that many. Even on a good day, it's less than half the prior traffic. So the idea that, the coast is clear is just not true. Now, what does that have to do with the price of gold? The world needs oil. Now, there is oil around. The U.S. is not going to run out of oil. We have seen higher prices. We're not immune from a world price, but we're a net exporter. We get plenty of oil. We've taken over the Venezuelan oil. We're good friends with Guyana, right next door to Venezuela. They might have larger reserves than Venezuela, for all we know. So we're still exploring that. We kicked the Chinese out of the Panama Canal, and Trump's opening up leasing opportunities for oil and natural gas on federal lands, the Gulf of America, Alaska, and elsewhere. So the U.S. is not going to run out of oil. Neither is Russia, but they don't have enough to supply what's missing from the Persian Gulf. So will we send some to Japan because they're friends of ours? Yeah, but what does that do for Malaysia and India and in Africa and Europe, for that matter, and other places? The answer is not much. Russia could supply all the natural gas Europe needs, but the Europeans just seem to be intent on economic suicide, basically cutting off the Russians for no good reason. So again, how does that affect gold? Well, the answer is all of those commodities I just described are priced in dollars. They just are. And if you want those commodities and they're in short supply and the price is going up, you need dollars, and the price goes up more, you need more dollars. Well, how do you get dollars? Well, one way to do it is to sell gold and get dollars. So that created the downward pressure. In other words, countries, they said central banks are net buyers, and they are, but some countries, including Turkey, Russia to some extent, China and others, sold gold to get dollars to buy oil. So the downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends, all the things we were just talking about. It had everything to do with the fact that the world was short of dollars and needed them, and one way to get them quickly, because it's liquid, is to sell gold. So that starts the downward price pressure. Then it feeds on itself. So all of a sudden, leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. They're like, hey, it's going down, sell more. And then you hit more stop losses. It feeds on itself, and it keeps going down. So the trigger was the dollar shortage. So it was sell gold, get dollars to buy oil because you need the oil. And then the momentum continued for the reasons I mentioned, which is stop losses and just, momentum traders. Okay, so we are where we are. But all that's beginning to run its course. The war in Iran may continue, probably will, but some oil is getting out. Other suppliers have increased their output. Oil prices have dropped from, as much as $110 a barrel down to around 70, 67 when I looked this morning at some of the tickers. So that urgency about getting the dollars is diminished. Number one, some oil is getting out, not enough, but it's getting out. So a lot of that pressure is off. And I go back to something that Jim Rickards told me, it was 8 or 9 years ago. But Jim Rickards is probably the most famous commodity trader of all time. Partner was with George Soros in the launch of the Quantum Fund, and Jim has had a great career, kind of really a legendary figure. He told me, because this was in, gold peaked, the last peak was 2011. August 2011, gold peaked around $1,900 an ounce. Then it went all the way down to 1050, December 2015, 1050. So it was somewhere in that, kind of closer to around 2014 or so when we talked. And gold was going down pretty significantly. And we were in the Dominican Republic having a drink. And I said, Jim, what do you think? And he said, well, I'm holding gold. I'm not selling any. And what he said to me, I'll never forget. He said, in commodities trading, nothing goes to the moon without a 50% drawdown along the way. And if you're not ready for that, you're in the wrong market. Just get used to it. That's how commodities trade. Well, sure enough, now when you say 50% drawdown, you have to pick a base. So if you do the math, I took a base of $250 an ounce. That was the low in 1999. That was like the post 1980 low. Was 1999, $250 an ounce. So I took that as my base, went up to $1,900. So as the peak, divided by 2, took that, subtracted from 1900. Guess what I came out with? 1070. Guess where it bottomed? 1050.
The recent correction has left many investors wondering if gold's bull market is over. Jim Rickards doesn't think so. He believes the long-term fundamentals remain firmly in place. Central banks continue buying gold. Mine supply remains limited. Inflation concerns haven't disappeared. And geopolitical uncertainty is still supporting demand for safe haven assets. In his view, none of the core reasons for owning gold have changed. So why did prices fall? Rickards argues the decline wasn't caused by weakening confidence in gold. Instead, it was driven by a temporary global shortage of US dollars. As energy prices surged and countries needed dollars to secure essential commodities like oil, some governments sold gold simply to raise cash quickly. That initial selling then triggered stop-loss orders and momentum trading, accelerating the decline even further. According to Rickards, this was more of a liquidity event than a change in gold's long-term outlook. As those temporary pressures begin to ease, he believes investors will once again focus on the bigger picture, one that still supports higher gold prices over time. But the dollar shortage was only part of the story. Next, Jim explains how global supply disruptions could become the next major catalyst for gold.
In other words, Rogers was like right on the money. Not surprising because he gets this. Now, not to get too geeky, but there's something as a branch of mathematics called fractal mathematics, and it has a principle called scale invariance. What does that mean? It means if you take a 1-week chart of the stock market and put it next to a 10-year chart, but take out the dates, they look the same. In other words, these patterns repeat at different scales, but it's the same pattern. So taking what Jim Rogers taught me, applying scale invariance, and looking at today's market, now we need a new base because I was using, I think, around $1,800 an ounce up to the 53.55. Take the 50% of the difference, subtract it from 53.55, you come out around 3,600. So in other words, I'm not saying the gold is going to go to 3,600. I am saying it wouldn't shock me if it did. But the importance of that is it's the same pattern that Rogers described to me. It's the same pattern we saw from 2011 to 2015, a little more compressed, but that's okay because as I say, scale invariance means it's the same thing in a shorter time frame. So on a fundamental basis, which we talked about, central bank buying, flat mining output, inflation concerns, uncertainty, et cetera, gold should go up. But even on a more technical basis, and I'm not a technical analyst, but I do understand fractal math, but using the Jim Rogers rule, a 50% drawdown from 53.55 should not be surprising. Well, we're there. So I think this is played out in unsurprising ways. But the other side of that is we're ready for the next stage of the liftoff. So, yeah, I think it's a very good entry point.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now,
Back to the interview.
Excellent breakdown. And one of the main catalysts a lot of people have been looking at recently is the fact that gold officially surpassed US Treasuries as the most widely held reserve asset. This was originally reported at the end of 2025. The ECB recently released a report that brought it back into the spotlight. What is this telling us about gold's role in the monetary system? And do you think these central banks stacking gold know something is coming ahead, a monetary reset of some kind? Are they simply removing wealth from counterparty risk? A lot of people point to the US and its allies freezing Russia's FX reserves as a big catalyst for governments around the world to kind of wake up and realize, hey, we need an asset that has no liability or counterparty risk. What are your thoughts on this development?
Well, Jesse, you're right about the fact that gold surpassed U.S. Treasuries or, pardon me, U.S. dollar denominated assets as a percentage of global reserves. That's just a fact. But it's important to know why. It wasn't the case. Again, central banks are net buyers. I want to be clear about that. That's been true since 2010. But it was not the case that they just dumped treasuries and bought gold, and that's why gold went up. What happened was they had a certain amount of gold, they had a certain amount of treasuries. Treasuries, they can be volatile, but they don't move around that much in price. But gold was more than doubling, it was almost tripling in a fairly short period of time. So, and they were adding gold, but even with the same quantity of gold, if you triple the price, then in dollar terms, it's going to be a bigger percentage of total assets. So yes, gold did surpass treasuries as a percentage of total reserve assets, but it wasn't so much because they were buying enormous amounts of gold. They were buying some. It was because the price tripled, and that's what happened. It's like any portfolio. When you have a winner like that, it's like, it feels good, but you might have to reallocate your portfolio a little bit. So yes, gold surpassed treasuries, but the reason was because the price tripled, not because they bought so much more gold. Now, having said that, it begs the question, well, why are they buying this gold? And that's kind of what you pointed to. Do they see something coming? I think it's already here. And what it is, this goes back to 2022 and the Russian special military operation in Ukraine. And it's here we are, 2026. That war is more than 4 years old. It's not going to be over for maybe another year, but it's been a pretty brutal struggle. Russia is winning. They're going to win, but they're in the process of winning. That's very clear. I know that Ukrainians are sending drones to Moscow, but yeah, okay, a little damage, but not that much actually. But what's going on there is that Russia had $300 billion of U.S. Treasury securities in its reserve position prior to the outbreak of the war. And this is the work of Vera Nabiullina, who's the head of the Central Bank of Russia. I always say she's the only central banker in the world who understands her job. She's actually pretty good at it. But if you go back to, I'll just say January 2022, before the war, the Russian reserve position was approximately $600 billion. Of that, $150 billion, or 25%, was in gold, physical gold bullion in Moscow. We're not talking about tokens or futures or anything else. They had the gold in Russia. But they also had about $300 billion in treasuries. That was, and then the rest was in, some euros and some other assets. So but what do you do with $300 billion of treasuries? Well, the last printed treasury bond was issued in 1979. People talk about digital, crypto, all this stuff. The treasury market has been digitized and with encrypted message traffic since 1979. So it might be the original cryptocurrency. But when you have that, you're talking about a digital ledger. Okay, who controls the ledger? Well, now you need a custodian. The ultimate control is with the United States Treasury and the Federal Reserve and FedWire. The Federal Reserve acts as fiscal agent for the Treasury, so they control it. But in between, you have custodians like Euroclear and Citadel and DTC and others. Well, the Russians had about 200 billion out of their 300 billion in custody at Euroclear in Belgium. Because why? They trusted the Belgians, they trusted the Americans. Big mistake. So what happened was the U.S. and Europe together froze those assets. So they're still there. Actually, I say they're still there. They have matured.
That wraps up Jim Rickards' latest perspective on what's happening in the gold market. While short-term price swings can create uncertainty, He believes the bigger forces, central bank demand, limited supply, geopolitical risk, and long-term monetary trends, continue pointing in the same direction. Of course, no one can predict the future with certainty, so always do your own research before making any investment decisions. If you found this breakdown valuable, be sure to subscribe and turn on notifications so you never miss our latest updates on gold, silver, the economy, and the global financial system. Now we'd love to hear from you. Do you think this correction is a buying opportunity, or do you expect gold to fall even further before the next major move? Let us know your thoughts in the comments below. Thanks for watching, and we'll see you in the next video.